Hello, everybody. It is busy, busy, busy. I know I got to get this cord out of my way here. Um, Great to be on the floor. It is rocking and rolling. Not quite as much as it was a couple days ago, not quite as much as it was last week, but there is a lot of activity. And as we speak right now, SPOO's just hit, S&P's just hit their high of the day. I saw up 102. I'm looking up here right now. They're up 93 right now. Again, why is the market up? It's news driven. It is all news driven. In fact, those of you that may have been following the markets overnight, okay, and I actually didn't sleep very much last night, but if you were following the markets overnight, there was some news that came out, I want to say somewhere around 3 to 4 o'clock Central Time here, coming out of China, basically saying things opposite to what we have been hearing about potential deals and talking with China. China came out and said, you know what, we haven't talked to the United States at all. When we heard earlier in the day that they're having talks. So the market overnight, S&Ps were down. I think I saw 35 at the low. Maybe they ticked a little bit lower than that. Dow futures were down over 300, and then you know what? We got to the opening of the market here today, and we were flat and kind of have not looked back at all. Now, this last pop from just over the last 15, 20 minutes, where we went from up 75 or so in the S&Ps to up near 100 right now. News came out from President Trump saying that they did, in fact, meet this morning. So who knows? Maybe they didn't meet prior, and that message, the messaging from Xi in China was on point, and so they rushed to meet this morning. Regardless, whatever it is, I'm just reporting what happened and what is moving the markets. So there is a lot of volume. Now, what's really interesting on this move higher of the SPOOs up 100 points, basically, the VIX, I'm not going to say it's unchanged. VIX is down 1 point. Okay. Normally on a move like this to the upside here, we would see just volatility getting absolutely hammered. And it's not. So what does that tell me just as a trader, my spidey senses? Okay. I'm not saying we can't watch the market closely. I'm not saying we can't watch the market okay. I'm not saying we can't what the traders over there in the VIX pit are telling me is this volatility is far from over because otherwise we'd see the VIX down in the low 20s. I don't think we're getting there anytime soon. I really don't. Okay. We are going to see these big news, but almost on a daily basis, these big moves. And what are those big moves coming from? They're coming from the news flow. Okay. They're not coming from earnings. They're not coming from the eco data we got this morning. Horrendous eco data. Terrible economic data this morning. In fact, the Atlanta Fed GDP came out about an hour ago or so, and they actually lowered their forecast for the first quarter GDP from a -2.2, which is what it was. They now lowered that to -2.5. So the market may have actually looked at that and said, okay, even though that is really crappy for the economy, maybe that puts some pressure on the Fed to lower rates. Okay. So I actually did an interview this morning on one of the news channels. Excuse me about that. Sorry. I did an interview this morning and they said, well, if the Fed does wind up lowering rates, is that actually going to be a good thing? And my answer to that was sure, we all want lower rates, but we want them because things are okay. We don't want them because things are getting really bad, right? That's where we don't want it. So I actually think that if the Fed does lower rates, and they have a meeting coming up in May, another one in June. The first one is like 2 weeks away, a week and a half away, another one in June. They're most likely not going to do anything in May. If they wind up lowering rates in June, I actually think the market reacts very negatively to that. So that's my opinion on it. Now, let's let's talk about our oh, sorry, Mike, you're adding, I'm taking away. There we go. let's talk. What happened there? What is this? Uh-oh. What happened here? Hang on, everybody. Okay, there we go. What was going on over there? We good? Okay. Everybody can Alexander in Italy. That's amazing. What part of Italy are you in? Thank you, Mike. What part of Italy are you in? That's amazing. All right. Awesome. So I had asked the crew this morning, what do we want to talk about in Market Minds today? You know, besides what is going on here and all of the activity, and it is pretty loud down here right now. So if I'm actually talking louder than I normally do, it's because I'm trying to hear myself, to be quite honest. But somebody said, "Hey, can we talk about the benefits, good, bad, indifferent, the difference between putting on a butterfly spread and putting on a debit spread?" Okay, Mike, everybody can hear me? We can hear good? Yeah. Hey, everybody out there in the chat, if you can hear me okay, can you just let me know in the chat here so I know that I'm not speaking to myself like I do very frequently, which sometimes is not the worst thing in the world because then I don't get bad answers. Thank you, thank you, thank you, thank you. Okay, so first, let's talk real quickly. What is a butterfly spread? We've gone through this before, okay? And then, in fact, those of you that are in OpVal, okay, we put on a butterfly spread this morning in FUTU, F-U-T-U. Happened to be a broken wing butterfly, which what I'll go into in a moment, but it was a butterfly spread. In a butterfly spread, you use three different options, okay? They all are either on the call side or the put side. So they're all on the same side of the ledger. If it's an iron butterfly, which you can trade, just like when we trade iron condors, that would be a combination of calls and puts. We're focusing just on a butterfly. It can be a call butterfly, a put butterfly. In fact, we have a put butterfly on right now in Tesla. So we have one bearish and one bullish butterfly. So the options are all the same expiration. Okay. And in a normal butterfly, the width between the strikes are equivalent. So the long and the short could be $2.50 wide, $5 wide, whatever it is. And then the width between the short and the next long, same thing. Okay. Just like any other position, just like any other spread out there, we always want the stock to move to the short strike. Okay. We max out our profits at the short strike at expiration. Okay. So with a butterfly, think of it this way. We have one long call spread and one short call spread, or one long put spread and one short put spread. It's in a 1 to 2 to 1 ratio. Okay. Now, we can trade other butterflies. We do that on occasion. We trade 1x3x2s or other ratios. Okay. That's still a butterfly, but that is not what is known as or called a regular butterfly. A regular butterfly is in a 1 to 2 to 1 ratio. You want to do 10 of them, you would do 10 by 20 by 10. Okay. So I pulled some data here, which I'm going to show you in a second here, some charts, so we can go through an actual example of a butterfly versus just using a call spread and the difference. Okay. This, you'll see this later. This is just some more information that I just talked about on what a butterfly is. But when you're buying a butterfly, you want the stock to move to the middle strike, which is the short strike. Just like every position we have, we always want the stock to move to the short strike. So I used NVIDIA this morning. Okay. And I pulled this like an hour ago as I was preparing for this. I need my drawing tool here. Mike, where's my Epic pen? Hang on, everybody. Epic pen. This one? There it is. Thank you. Thank you. Thank you. So at the time, okay, at the time, the video was close to 105. Okay, can everybody see where I circled that on the screen there? And Don, I hope you're in here because I think you're the one that asked me to do the difference between a butterfly and a debit spread, just a debit vertical spread. So, okay. So the video is 105. So just like the process would be for any other trade that we're looking at, what do we do first? Well, we want to see what the expected move is, right? Regardless of the expiration you're looking at in a day, a week, a month, whatever it is, we want to look at the expected move. So if I look at the expected move here at the time, again, I know Nvidia is higher right now, but this is where it was. The expected move was about $9. Okay. Does everybody see that? Great. So I'm going to use a bullish example. This is not a signal I'm putting out. This is not something where I'm saying, hey guys, go out and buy this spread. Okay. This is purely for example purposes right now. So live TV, everybody, dropping my mouse. Okay. So our target is really, let's call it 114. Okay. If I take where the stock was and add in the expected move, if we were putting out an example on the put side, on the bearish side, we'd be targeting 95. Okay. So what I did here was break down using the same expected move, still bullish strategies on both the butterfly and the debit vertical spread. Okay. So here we go. Let's start with the butterfly first. Okay. So let's say we're bullish. The video is trading 104.75. We want to target 114. We just went through that based on the expected move. The markets, which these are what the markets were at the time. So if you're going to ask, where am I pulling those prices from? I'm pulling those prices right here where those markets were live at the time I did this. Okay. So targeting 114. And in this case, what I did is I just kind of rounded these strikes. Okay. Because that's where the big liquidity is. So I rounded targeting to the 115. Okay. So I put up here a $5 wide butterfly. Now, this is a real butterfly because it is $5 wide on the long call spread of 110, 115. So we bought that spread while at the same time simultaneously selling the 115, 120. 1 by 2 by 1. We have a long call spread. We have a short call spread. What do they both have in common? They both have a short 115 strike. Why is the 115 strike? Because that's the expected move. Okay. And this cost, again, how am I getting the pricing on this? This was the real pricing at the time that I did this. This butterfly would cost 60 cents to put on. Okay. Is everybody with me? So buying the 110, 115, and at the same time selling the 115, 120, that would cost me 60 cents. Okay. Pretty cheap, right? If we're targeting 115, I want an upside play here. Boy, that is really cheap. That is fantastic reward to risk. Right? And what you will see with butterflies is you do see really, really, really big reward to risk. Further you go out in time, the better that reward to risk is. Okay. The reason you see that big opportunity, that big reward to risk opportunity, is because you're kind of playing a little bit of a game of darts or pin the tail on the donkey. Okay. What do I mean by that? Well, let's look at the next slide. So what I did here, and let me see if I can make this any bigger. Hang on. There we go. It's a little bit bigger, I think. Okay. So what I did here is at expiration, okay, I set out prices for the stock. Now, what you can see is anywhere 110 or below, we're going to lose our investment, right? Because all of the call options are going to be worthless at that point. So if we are at 110 or below at expiration, it's worth a goose egg. We lose our 60 cents. Okay. Cheap, 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 but we lose our 60 cents. Our break even would be 110.60 because our long 110 call would be worth 60 cents, which is what we paid. That puts us at a break even. Now, here's where the fun begins. Okay. As the stock moves higher and as it gets closer and closer and closer and closer to that short strike of 115, we see our profits go higher. And the reason for that is if you break it down, it's because the long call spread that we have is getting closer and closer and closer to maxing its value, which in this case is $5, the difference between the strikes, while the short spread is still worth zero. So as we get closer to 115 and then finally at 115, you can see that would be our max profit. Everybody with me? Here's where the big difference between a butterfly and just a straight debit spread is going to come into play. And I'm going to show you the debit spread here in a second. Okay. Again, your reward to risk, fantastic. Great reward to risk. But you're getting great reward to risk because you have more risk to the trade, not risk of this not working or going higher, but you have risk that if the stock goes too high, moves too much, even though we were bullish, we could actually lose on the upside also. So that 115 is our sweet spot. Now, what happens over 115? Well, if we go higher than that, 116, 17, 18, whatever it is, the long part of our spread doesn't gain in value. We're done. That has maxed out at $5. But the short part of our spread, now starts getting value. So even though we're making profits, we're making less and less and less profit. And then if we get, in this case, to 119.40 at expiration, okay, that's another break even. So we have a break even here, we have a break even here. And if we get to 120 or higher, so even though we had a bullish position on, if we get to 120 or higher, all of a sudden we lose everything because now the long spread and the short spread are worth the same. We lose our investment. So that's why you will get much higher reward to risk, much higher bang for your buck trading a butterfly because of this part of the trade. Okay, does everybody understand that? Okay, now, same exact scenario. Stock was same place, expected move is the same. Still want to target 114. We're going to target 115 here because that's what we did in the butterfly example. But here, instead of trading a butterfly, we're just going to trade a call spread. Now, you can see the price is almost double. 60 cents on the butterfly here. This trade is $1.15. You may look at that and say, boy, why would I want to pay $1.15 when I could pay 60 cents on the other spread? I'm still targeting the same area, right? I'm still going to max this out if we get to 115, right? Wouldn't this max out if we get to 115? Okay. And before I go on to the next slide, let's do that. I didn't bring in the Hulk today. I didn't bring in Groucho. I've been running around. And so I just put this up here since I am standing here. Word of the day, acronym of the day, ETF or future of the day, whatever you want to call it, SPX. Okay. SPX. Which, by the way, I just actually learned a very fun fact about the SPX as I was down here earlier today. I actually had a group of students, high school students, that I brought onto the trading floor today. I helped teach a class at the local high school, and so one of the gentlemen from the CBOE was explaining what trades here, and so two things, very cool actually. On an average day here in the SPX, there's almost $8 billion in notional value that is transacted. Okay. $8 billion of all of the contracts that are traded here. Okay. approximately 80% are electronic, 20% live on the floor. Okay, so that was just an aside. Figure I'd let everybody know that. Okay, so here we are back to our call spread. 8 billion. That is, yeah, that's a billion that you got up there, Paul. That is right. Billion with a B. That is correct. Okay, so the 110, 115 call spread using the same exact strikes costs us $1.15. Now, here's why it costs more money. Okay, let me blow this up again here. Whoops. Okay, so here's the P&L graph on the call spread. Same thing. If we don't get to 110, this thing's going to be worthless at expiration. And yeah, we've lost more money. We've lost $1.15 here instead of 60 cents in the butterfly. Okay, our break even is also a bit higher. Our break even in the butterfly was 110.60. Our break even here is 111.15. Okay, if we get to 115, that's going to max out our profitability. That's going to max it out. So we make money all the way to 115. Now, here's where the big difference is. Here's where the change is. Here's why you pay more for this than a butterfly. And I'm not saying one is better than the other. I'm pointing out what the differences are. Remember, in the butterfly, because we were not just long the 110, 115 call spread, we were also short the 115, 120 call spread. Once we hit 115, if we started to go higher, we started giving back profits. Right? We started giving back profits. Here, we're maxed out. Stock can go to 115.10, 118, 130, 190, 270, whatever it matters. Doesn't matter. So the extra premium you're paying just to have the call spread versus the butterfly, okay, is because you have this benefit on the upside that you don't have with the butterfly. Does that make sense to everybody? Is there anybody in here right now from the Option Essentials room? Thank you, Carlos. Dave? Is there anyone in here that has the frog? Yes, like toad, frog. Thank you, Herbert. Position on in Option Essentials? Did we fill at 80 cents on our partial exit there? Thank you, Steve. Carlos? Exactly, Carlos. You can look at it is that your losses, thank you, Jeremy. Your losses in the call spread are only on one side, not both sides. Now your losses are a little bit bigger on that one side, but you don't have the losses on the other side. Thank you, Paul. Okay. That is the difference, a very basic 25-minute discussion, difference between trading a butterfly and trading just a vertical spread. Same principles hold if we had gone through a put example. Okay, frog not filled. Okay, that's what I was asking about. Okay, great. Great. Okay. So if you are bullish, then a broken wing is a good option. So Don, if you think about, let me go back to this chart here. So this was our butterfly chart. And the butterfly chart shows those losses on the upside because this is based on an equivalent distance between the strikes. $5 on long, $5 on the short. What a broken wing does, like what we have in Tesla, like what we have in Futu, okay, what a broken wing does is it skews the long part of the spread versus the short part. So in Futu, I think we have a $7 wide long spread and a $2 wide short spread. So even if you move, you blow through your short strike, which is optimal, you're still going to win. So you pay more for that because you still win. So we really don't trade regular butterflies in here. We will trade broken wing butterflies. conceptually, everything is the same. It's still a 1 to 2 to 1 ratio, still all the same expiration. But the equivalent, the difference between the strikes is not equivalent. That's what gives us the delta bias, either positive or negative, depending, whether you're using calls or puts. All right. And Don, thank you to you, because you are the one that I believe gave us the suggestion this morning. All right, everybody, here we go. Here we go. The wheel is closed and the wheel is spinning, and I'm busy between listening to all the noise back here and looking at the spinning Mike Duke or Monty Mildenberg. Mike Duke is a winner. Is Mike in the house? As we wait for Mike to answer, anybody looking forward to the NFL draft tonight? I am. Mike Duke is in the house. That is wonderful, Mike. Mike Clark, are you going to put up there? Thank you. Mike, you're going to see an email here real shortly. Send me an email with your info. Okay, and we'll get you some swag. I also want to put out here for those of you that don't know, then I'm looking for my link. Mike Clark, do you have a link for tonight? I need a link for tonight really quickly, please. Jeff Lake and I are doing a dual webinar tonight. Okay, we're doing a dual webinar tonight. We're going to talk about state of the markets. We're going to talk about how we've been trading in the markets. We're going to talk about where volatility is, and we're going to talk about his new mentorship program, which we are all extremely, extremely excited about. So here is, if you guys want to tune in tonight, there is a link to our webinar tonight for Jeff and I live. And Robert DB, as always, I appreciate your help. Everybody, if you could smash, thank you, Paul. If you could smash the like button, that really helps us out. Jeremy, you're very welcome. You're very welcome. All right, guys. I'm going to do this, on the floor as much as I can now. Especially while it's so busy, so active down here, and it's boy, there's a rush. You could probably tell that I'm like a little bit hopped up here today, and it's only because of pure adrenaline rush from what's going on here. Herbert, you are very, very, very welcome. I appreciate all of you. All right, everyone. Have a fantastic rest of the day. As I leave you, S&Ps are up 96.5 points. 54, 97, 50. It still concerns me a little that the VIX is only down 90 bips, still trading 27.55. But thank you, Paul. Have a great one, everybody. I appreciate all of you. Have a great day.